Okay, welcome everyone. We're going to first start with just a little bit of introductions of myself and Kim, and then we're going to go into uh, a little bit kind of like presentations, but we want to keep this very informal. We want you guys to be able to ask questions too. So we'll do a question and answer session at the end, but if you have any questions as we're going along, please put them in the chat. Okay. I am Shel Sawyer. I am a certified divorce financial analyst, a certified divorce coach, a mediator, and a certified co-parenting coach. So, um, oh, I'm gonna put this off for a minute. Okay. I got a little distracted. Sorry about that. But I'd like you to introduce you to Kim. Kim, tell us a little bit about yourself.
Hi, everyone. Kim Kasner. I'm a certified divorce lending professional. I'm a mortgage originator. I've been in the business for about 23 years, helping clients, to gain access to purchasing properties. And then on the CDLP side, it's helping the client that is getting divorced, figure out what to do with the marital property, whether they need to refinance it, if they're going to keep it, or they may find out that they don't qualify and they may want to sell it. So I'm here for questions.
And I find her a great referral partner for myself and working with my clients. She's wonderful when we're looking at all aspects of the home. So I
Thank you, Shel.
appreciate her help and helping my clients so much. Okay, so I have a little bit of a presentation that I am going to display, and hopefully everybody can see it. Usually takes a little while. Okay, so here we are, her divorce home planning webinar. Okay, keeping, selling, or refinancing. What's the clear path for you? So, I mean, why is this decision so hard? It's hard because the family home is really the most emotionally charged and financially complex asset in a divorce. People often feel torn. They feel torn between the sentiment of the home, the fear of change, is the stability for their children, or if the financial uncertainty of it. So my role is to help bring clarity, a little bit of calm, some structure to a decision that really feels overwhelming. Did you know that 70% of divorcing couples own the home together? And most decisions are made without complete financial information. But I want to say, with the right guide, clarity is possible. So this is who I am. I mentioned this before. I also want to mention that I am not just a certified divorce financial analyst. I'm also, I have my master's in accounting. I worked over 20 years, I won't say how many years, in the financial services industry. I've always been a financial girl at heart, since I sat at my dad's dining room table and he taught me all about money. I've loved it. But I help you make the right decisions for your home and your future. I like to say I kind of have a little bit of a dual lens on this. I have financial clarity about the numbers, projections, affordability, and your long-term impact. But I also bring a little bit of emotional grounding, helping you slow down, breathe, and make decisions from a place of stability rather than fear. So the way I look at the home and the choices that are there to make, there are three different paths. There's the first path. First path is very common, where one spouse keeps the home. Then there's the second path, which is selling the house. And the third one, which I don't recommend very often, but sometimes it makes sense, where one spouse who's moving out of the house stays on the mortgage temporarily. Okay. So let's talk about path A, path one. This is where one spouse buys out the other and refinances into their own name. This requires careful affordability and emotional readiness analysis. When does this make sense? This makes sense when one spouse wants to keep the home and they can qualify for the mortgage independently. Here's some things that are often overlooked: taxes, maintenance, insurance, your future cash flow, and the cost of buying out the other spouse. And how I can help is I can bring a realistic affordability analysis, give you some future projections, and a plan that helps prevent being house rich and cash poor. Selling the house. This is when both parties decide to sell the house and divide the proceeds in accordance with the agreement. Agreements are always the most important aspect on this. Kim and I were talking about this beforehand. What's in your agreement really needs to be written well, and it really needs to identify everything about what you are doing with your house, the timing of it, how you're paying off the other spouse, that buyout, how long you have to refinance your house. That's, I guess, the timing. And in tax implications, there are a lot of them around the house. They really matter. Okay. Um, and so when does that make sense? This is when neither spouse can afford the loan, or they both want a clean, financially, and equally important emotional break. There can be a lot of emotional challenges around this, right? There's grief, there's loss of identity, and there's fear of that unknown. How I help is I help prepare my clients emotionally, understanding their tax impact, and planning for the next housing step. And then this last one, when a spouse who's moving out, they stay on the mortgage temporary. Like I said, should be temporary. This is really an interim solution while longer term plans are finalized. This must be approached very strategically and protect both parties. So out of all three of these, this third one has the agreement has the most impact on not just the person who's staying in the home, but the person who is leaving as well. Because when one person wants to keep the home, but maybe so it makes sense if they can't qualify to for the mortgage right now independently, but maybe in the future they can for some reason or another. In this, there's some hidden complexities that I want you to be aware of. The spouse moving out really has to be okay with the scenario because it can impact their credit. And the leaving spouse's credit, it really needs to be written appropriately in the agreement so they can qualify for another loan down the road. There's some good language that needs to be included in your agreement so you can be qualified for another loan down the road. Maybe Kim might touch on this a little later too. And how I can help. I can coordinate you with a lender. I know a good one. He's on the call. I can run scenarios and we can ensure that the prospective refinance can happen down the road. This this home, it's really just it's never really just a building. I'm having trouble talking today. It must be Friday. But it has a lot of life in it, right? You have memories, you're really holding on. And divorce can trigger these, right? There's fear, there's guilt, there's nostalgia, there's a lot of pressure, especially around the house. Many clients, they feel they should keep the home, even if it's not financially wise. And others feel ashamed or defeated if they can't. But my role is to normalize this. These emotions can help clients separate the emotion from the financial reality of it. I like to call myself a voice of reason because your home should not just support your future. It should support your future, not strain it. Laugh. Okay. So here are some common mistakes that divorcing homeowners make. And this comes into play all the time. I see it. Not with my clients. So what often happens is they keep the home without a full affordability analysis. They're not really looking at the big picture. Sometimes people agree to a buyout figure based on Zillow. Zillow is not a person, it's an algorithm. It doesn't get it right 100% of the time. Actually, it doesn't get it right very often at all. Um, and they remain on the mortgage after the divorce is final. This is a big one. I'm not a financially, I'm not a fan of staying on the mortgage after the divorce is final. It, God forbid, somebody misses a mortgage payment, it will impact your credit down the road. Even if you have a little bit of language in there to help you, it could be very devastating to your credit. Not to mention, there's a lot of things that can impact your credit after after a divorce, but this mortgage one is a big one. And sometimes people rush to sell during a very emotionally volatile period instead of kind of doing that analysis, right? I have a lot of people come to me in mediation and they've already sold the house. They haven't, you know, done any analysis. Somebody's like living in somebody's basement. It's not ideal, right? And then they make home decisions in isolation. They don't look at the full big picture of what their finances look like. So this can like really lead to some mistakes, right? So what I do with my clients is I help look at a full financial affordability assessment. That's a mouthful. I bring in certified appraisers. We look at competitive market analysis, and we bring in certified divorce lending professionals. Um, Getting removed from the mortgage, you need a timetable on that. You need that written into the plan in the agreement. We create a strategic timeline based on a plan, and we view your home decisions as part of your whole financial future, not just a piece of it. So the right guidance doesn't just prevent mistakes, it protects your financial future and your peace of mind. So this is kind of my step-by-step process of making that home decision. I really start with this discovery phase. This is like understanding what your goals are, your fears, your financial reality. Then we go into a little bit of analysis. It's a full analysis of your income, your assets, your mortgage, your equity, and your credit readiness. And then we look at your affordability and options. What's looking at clear reports on can you refinance? So is that affordable? Would it make more sense to sell it? What could we do with some options? And then the coordination. I work alongside your lender and your real estate agent so nothing is missed. And we make confidence decisions so you can move forward with a plan. This kind of brings you from uncertainty to clarity, and it's one step at a time. The right home decision sets the foundation to post divorce stability and successful transitions into your next chapter. Your future is bright if you make thoughtful, informed choices now. Divorce is hard, but home decisions don't have to break you. With the right guidance, you can make a choice that protects your emotional well being and your financial future. I'm here to walk with you step by step through one of the most important decisions in your life. You deserve a future that really feels stable, grounded in yours, and I'd love to build it with you together. I'm going to stop sharing now, and I'm going to transfer it over to Kim.
Thanks, Shel, for all of that. I mean, you definitely gave some clarity on things. So I'll pick up on the mortgage side of it. So basically, when you're looking at divorce, you're looking at qualifying on one income, and that can be difficult for people. But we need to look at if you want to keep the house, is it an emotional thing, or is it really just something that feasibly you can do? So we can look at we tend to look at your income, your debt to income ratio, how long you've been employed, your credit score, the employment stability, your existing debts. The debts are something, you may have joint credit cards that now you're going to be splitting up, and you need to think about whether you're going to keep those debt, whether one of you is going to keep the debt or you're both going to split it, and you got to figure out how to break that apart. But we have to take that into consideration too when we're qualifying you. The other thing, just because a divorce agreement says someone can keep the house, it doesn't mean that the lender is going to say you're able to get a mortgage. So you have to keep that in mind too. And then we look at how to get you set up to where you can get a mortgage. So your divorce decree is something that is very important, and Shell touched upon that with the settlement agreement, the divorce decree. Some people believe that just because the decree assigns the house to one spouse, the other spouse is no longer responsible, but that's not true. You have to be careful with that. The other spouse is still liable until they get refinanced off or you sell the property. And the lenders are not bound by the divorce decree. If both names are on the mortgage, they can still go after one or the other, whoever's not, if there's late payments or things of that nature. So if you're the one that is responsible for paying the mortgage, you definitely want to make sure that the payments are getting made. If your spouse is supposed to be the one, you got to take into consideration that they could have late payments. So kind of keep it open with them so that until you can get the house refinanced, you come off or they come off, however it works, so that you don't mess up your credit. Let's see what else here. Shell had touched upon alimony a little bit. Support rules for alimony and child support. Can we use that as income? We can. We just need to have it put into the decree or into the settlement agreement that you're going to be receiving it for a minimum of, has to be at least 3 years from the date of the divorce. What you need to do in order to start qualifying with it is you need to be receiving it for at least 6 months. So you can literally have it written into the decree that you're going to be receiving it, start receiving it, 6 months passes, and if the divorce happens after that, at least you've already started receiving the 6 months and we can utilize it as income. It just has to continue to be received at least 3 years past the divorce date. Otherwise, they're not going to allow it to be used as qualifying income. Your debt to income ratios. This is something else you're going to want to take into consideration, like I mentioned with the credit card debt. You don't want to have too much debt. With a conventional mortgage, we look at your debt to income ratio of a 43%. So you've got your income and you've got your debts. That percentage is 43%. Conventional mortgages, you really can't go beyond that. They may push it to a 44, but 43% is typically the cutoff. With FHA, we can go to 50, sometimes 55%. Do I recommend that? No. And I see Shell shaking her head. It's really, can we do it? Do we give people mortgages with a 50, 55% debt to income ratio? Yes, they can qualify, but is it a good idea? No, because you're going to struggle with everything else, because with debts, the only thing a mortgage lender looks at is your mortgage payment. They look at your taxes and insurance to be included within that. They look at car payments, credit card debt, and student loans. And if you might have a personal loan with someone else. Those are the only things we take into consideration. So we don't look at electric, We don't look at your water bill. We don't look at sewer bills. We don't look at anything else. It's just those specific items. So you really do have to look at what your budget is. You have to, and I know Shell will help you with that. Um, but you have to look at it and go, can I live this way? Can I still go out to dinner? Can I still go on vacation? Can I do things, or am I going to be living for the house? So I know it's emotional. Sometimes you get tied to the house, but really taking into consideration, are you going to be able to enjoy your life just to have that house? Um, so the other thing, if you're going to be the one refinancing, there is a little bit on buyout. We can do it. You can set it up where you're going to do a refinance. It'll be a rate and term as long as you both have owned the property for at least 12 months. So we can do it as a rate and term refinance. This is so that you can buy out your spouse. There's no cash back to the borrower. You can roll in your closing costs. So you can pay the closing costs. You can set up a new escrow account. You can do the buyout part of that within that. So you just can't receive any money back to yourself. We can consider, if we did it as a rate and term or as a cash out, it's going to be a higher interest rate and it's not going to be as beneficial to you. So we'd like to keep it at a rate and term because it's more beneficial to you. Credit issues during the divorce. This is talked about the credit cards. If depending on who's going to take over the credit card debts, are you going to have to pay those off? You got to watch out for late payments during the divorce. We look at missed mortgage payments. The worst thing you can have is a missed mortgage payment. The credit card debt is one thing, car payments are one thing, some late fees on things like that. Do not miss a mortgage payment. That is one of the worst ones that you can have because now they're going to look at it as, are you really going to be able to pay this mortgage if you're refinancing? So make sure the mortgage always gets paid. You can have a 30-day late on an FHA, but you really avoid it at all costs if you can. Just avoid the late payments on mortgages. Let's see. So future home buying eligibility for whoever is going to be vacating the property. They can, if within the divorce decree or the settlement agreement, if it says that one person is going to be responsible for keeping the house and the other person is to be moving out, we can we can qualify that person who's moving out for another mortgage, and it'll be considered a contingent liability, so it's not part of the debt to income ratio. But it has to definitely go into the divorce decree so that the lenders can look at it, because once you're divorced, we get a copy of the divorce decree, we get a copy of the settlement agreements, and that has to go to the lender that you're applying to for the mortgage, because they're going to want to see how everything is laid out. And that's where the conversation with Shell comes in. We look at things, what we're going to need within that divorce decree in order to, keep things moving along. So what you're going to want to do as you start going through this process, your first thing that you really should think about, if you're thinking about keeping the house, talk to a mortgage person, go over your debts, go over your assets, go over everything, your employment, and that way you'll know going into this, well, you'll have a little more clarity with the house, with the mortgage, so that it's not such a panic as you're going in. Talking about it ahead of time, getting things situated will make you a little bit more at ease, I guess. which is really what you need, during a time like this. Um, and that's about all I got here. If you have questions, you can reach out to me. I'll put my information into the chat, and
Yeah, put
we
your
could set up a time
information
and
in the
go over
chat.
things.
Yeah. So, you were talking about the debt to equity. I'm just like putting my 2 cents the debt to
You go
equity.
right ahead.
I can't imagine if you had, 43 debt to equity ratio. I remember my dad, this was before times are tough now, right? They're a lot different. But I remember my dad always telling me, like, never pay a mortgage or rent that's more than 25% of what you make. I mean,
That's
that's
right.
not true anymore, right? Like, that's hard to do.
Yeah.
But you have so many other expenses, like, I don't know, everybody has to eat, right? You have groceries that you have to buy. Those are really expensive now, too. I can't imagine the 43% debt to equity ratio. And that's just, hard.
And that's
But
that's on the conventional side. FHA is the
yeah,
50, 55
I
percent
know. When I heard that, I think you saw my face. So it's like cringe. It's
I
like,
did. I did.
yeah, 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 yeah.
It's
And then,
not you don't want to be in that. You would
no,
like to keep
I
it
know.
lower so that you can
Yeah,
live.
yeah. Kim and I have worked on many clients together. Like I've sent them her way, like when we're looking for a little clarity here. And, we've had some clients that have struggled to keep the house, right? And sometimes they want to do it at all costs. And we try to bring them clarity on what does this look like for you, right? What does your future kind of look like with keeping the house? And sometimes people want to do it regardless, right? And try to get that in there. And others, like, they're open-minded, they listen. We give them a lot of useful advice um, together, right? So yeah, that's been very helpful. One thing I had a question on, Kim, and um around the alimony and child support. I know really important. Like, if you are getting alimony and you're gonna get some child support, that can count as income um towards refinancing the house or putting it in your own name. Consistency, right? That's key. Is like you're
Yes.
getting that consistently, right? And that you
Yes.
to look at
So that's
that.
that's where that 6 month,
Yeah,
it has to be in hand. And
yeah,
you can show it by providing bank statements, but it has to be at right at that 6 months. Then we can start utilizing that as income. But even afterwards, it has to continuously continue, for at a minimum of 3 years,
right.
going
And
forward.
like, if it's written in the divorce decree that you're going to get it on the first of the month, you have to get it on the first of the month, right? Not the 15th of the month,
Yeah, they
right?
have
Not
to
the
they have to
30th.
receive it. Yeah,
Yeah.
because
Okay.
otherwise it's not, if you're getting it on the first, the second, the fifth, and then the 15th, it's not consistent. So they're going to look at it and go, is this going to be a problem? Are they going to be able to meet their expectations? Are they going to be able to pay the mortgage payment? And that's
Right.
really, I mean, the lenders are, that's all they care about. Are you going
Yeah.
to make that mortgage payment? They don't care about
Right.
anything else. That's all they
No,
care
they want
about.
to get their money. They
Yep.
want to get their money. Right. And I
Yep.
know, so, like, something else I just wanted to touch on. I was thinking about what Kim was talking is, like, sometimes lately, because the interest rates prior to this environment have were so been so low. Um, some mortgage companies, I would say mortgage companies are better than banks, but the mortgage companies are allowing unassumability. That's what they call it. And you have to find out if your mortgage company does it, but you're allowed to keep your um, mortgage just as is, right? You have to have the same terms. You get to keep the same rate. You can't add the buyout to it or anything. But sometimes they'll allow you to do it as long as you're able to be underwritten for it independently. So I just wanted to
Correct.
kind of put that out there.
Yeah.
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 It's something that can happen. There's a lot of people who have like, 2.5% interest rate. I think what's the interest rate at right now, like 6.5, somewhere around there.
Yeah. It
Yeah.
depends on the scenario. It depends on the
Depends on the
person's credit.
person. Yeah.
There's so many things that go into it. But they're in the sixes. Yeah.
Yeah. Yeah.
Yeah. And it's hard because property values have come up now. So it's a lot different for people. And I know when people have the 2 or 3% interest rate, they don't want to go into that higher percentage.
Mhm.
It's a little bit easier to do the assumability with an FHA.
Yeah.
Conventional, your lender really has to decide whether they're going to do it. There's no guideline that says that it can be. Typically, it's not, but it does it
Yeah.
it does happen periodically. Sometimes the lenders
Yeah.
go, okay, we'll work with you.
Yeah. Okay. We have a couple questions in the chat. If anybody else has anything, happy to answer them. Kim put her information in the chat as well. I will too. So the first one is after two real estate appraisals with my spouse not agreeing to meet in the middle of the two to get the home value, what would your next step be? So was it a real estate appraisal or a competitive market analysis? Because appraisals are different than
Hmm.
competitive market analysis. Usually a real estate agent does a free competitive market analysis. An appraisal you have to pay for, and it's usually done by um, a certified appraisal. I don't know what they're
Right.
no term is,
Yeah,
right?
they're
Kim,
typically
yeah,
certified. Yeah.
they're typically certified, and they cost money to get them, right?
Yeah.
You could do a third, right? If you're getting appraisal, have your husband get the appraisal. That is what I would tell you to do because they might not be agreeing because you got the appraisal. That's my experience. Okay. Get a third one. Let them talk to them. Somehow come in the middle there. The competitive market analysis. Not, I think I said appraisal, but I meant the competitive market analysis. Do have a real estate. Another neutral. It should always be neutral. That's where the problem usually comes in. If that's not, um, I would be surprised. It's usually somebody doesn't like who you use, or that you got it and they didn't. That's my 2 cents. My fee structure. So, um, as a cert, I call myself a divorce planner and guide. As a divorce planner and guide, I charge 300 per hour, and that includes everything behind the scenes. And that's standard. It's on my website. I also, if we're going through a full analysis, 5 sessions, I do a little bit reduction. It's 12.97 to do some divorce planning and guide services with me. And I offer a 30-minute consultation. And what about you, Kim? What are your fee structures? Do
I
you
don't
do free?
charge. I
Okay.
don't, you know,
Yeah.
I get paid when the loan closes.
Mm,
Will that change in the future? It may. But currently, I try not to get into charging people just to go through a prequal and to talk about some numbers. Um, it's it doesn't it I don't really need to get paid just to do that. For
mhm.
me, it's not like I'm going to sit there for hours and hours and hours on end going over things. So I
Yeah.
typically
It's
just,
quick and dirty kind of, right?
yeah, when the loan
Yeah.
closes is when I get paid.
Yeah.
So,
Awesome. Good. Thank you. Okay, so if no one else has any questions, I think we'll wrap it up here, and I will send everybody the video recording. Okay, thank you for joining us. I saw some people jumped off, so hopefully they'll watch the video on replay. Okay, I'll get that out to you. Thank you.
all right, thanks.